Rabbi, how are you?
I'm doing well, Gary. Every day is like the other. Um,
Yeah.
Homeschooling three children,
Oh,
and
ouch.
uh, I come from a family of teachers, and I know now why my dad was a clothing salesman.
Uh,
Yeah, I bet.
Yeah,
Yeah, it's hard for parents of school age kids.
yeah, yeah,
Mine
it
are
is,
past
and
that.
I think the social emotional part of this is starting to take its toll. They're
Mm.
missing friends, and
Yeah.
word about at least our summer camp was canceled for the summer, and that
Mm.
was quite a blow.
Yeah,
So
I bet. Yeah, that's too bad. Yeah.
yeah.
Like so many things. My daughter's supposed to get married in August.
Oh
That's on
yeah.
hold. Yeah.
Yeah. Is that off or just going to be a smaller crowd?
They're going to get married in one form or another, but it won't be what they
Yeah.
wanted, I don't think.
Yeah.
They haven't canceled it, but we're getting close.
Right.
Yeah.
Okay. Well, it's 1 o'clock. So welcome, Gary and John. Thank you for joining us. And as people are starting to show up online, we'll give them a few minutes to get settled as we make a few housekeeping announcements.
Okay.
And I really want to thank everybody, particularly Gary and John, but everybody in our office as well for helping to arrange this as part of this 4, maybe 5-part series. We're still working on a fifth of Let's Talk About It conversations for the Jewish community and beyond. We had a wonderful conversation last Friday with doctors Patty Daly and Eric Grafstein about public health in Vancouver. We're excited today to talk with John and Gary about financial planning in the midst of a pandemic. And then next week, Gail Krivel-Zaks will be talking about parenting in a pandemic, not a moment too soon. And then we'll round it out towards the end of the month, May 20th, with estate planning and end-of-life planning as a seminar as well. And we're trying to get a session with Jody Wilson-Raybould. We're just working on calendar to talk about the government's response. For those that are joining us in this webinar, you have the ability to ask questions, and we hope that you will. Don't use the chat feature for that, though. Please use the Q&A feature down at the bottom of your screen. That'll also give you the opportunity for others who see a question they like to click on the thumbs up mark so that you can upvote those questions so we know what is a priority for us to ask. All of the programs at Temple Sholom are available on our Temple website, templesholom.ca. And if you're interested in other activities or services that we have going on at the synagogue, I hope that you will check that out. We're also recording today's webinar, and we'll share it on Facebook and YouTube after it's done with the production, although it's live on those channels now also. So I want to welcome Garry Zlotnik. Gary's a member of our congregation and a cherished member of the broader Jewish community as well, and a longtime supporter of many organizations and institutions in the community. Gary's primary objective is always and has been his clients and their financial well-being, working with successful business owners and executives, his high net worth families and individuals. Garry is there through the full cycle of his client's business, circumstances, and life changes, providing trusted financial advice, never more needed than in the midst of a global pandemic, that's for sure. And as we all know, and I know personally, Garry is a passionate leader and has served as executive and board member to many highly respected industries and community organizations over the span of 35 years. I could list them all, but pretty much it would be easier to list the organizations you have not served on the board for, Garry. And an interesting just aside, when I first arrived in Vancouver 7 years ago and I would attend these fundraising functions, I seemed to always get sat. Garry and I always sat at the same table for almost every function. And it was a pleasure to get to know you that way, and then through your wedding and joining the synagogue. And so Gary's joined by John McKinney, who's president and portfolio manager at ZLC Wealth. As president and portfolio manager, John holds overall responsibility for client relations, business development, and administration. He brings with him nearly 30 years of financial sector experience in both portfolio and management and accounting. John is also well versed in independent investment management, having previously represented Duncan Ross Associates as president and overseeing all aspects of the operations from compliance and administration to client services and portfolio management. So I'm going to turn it actually to the two of you. I think you've prepared a little bit of an overview for us. You know, we're all sitting here with anxiety, not just about the pandemic, but about the after the pandemic, as we look at the economic impacts that this has had, not just the health impacts, but the economic impacts around the world and close to home. We look at our balance sheets and our bank accounts, and we look at our friends and neighbors, and in some cases ourselves, and see, you know, a lifetime of financial planning, if not wiped away, then certainly diminished in the space of just a few short weeks. And so we're looking for answers and explanations. So Garry and John, I'll turn it to you to give us a bit of an introduction and some initial thoughts.
Thank you, Rabbi. I'll start off. I don't know that we have any answers, but we certainly have some opinions and some where we think things are going. You know, when I started and joined my father in 1981 in the financial services industry, interest rates were 18%. The stock market had dropped 40%. And, you know, it was kind of like a rough period of time. And in 1987, the stock market dropped in one day 25 to 30%. And then in 2000, we had the tech bubble. And that was a horrible scene. And then in 2008, we had the frauds on the mortgage-backed securities that ran through the entire world and caused an economic downturn and crisis. And here we are, that was 2008, you know, 12 years or 11 and a half years later, here we are in something that appeared really out of nowhere and caused, you know, this current economic downfall. How do I feel right now? I feel worse than I felt in all the other times that we've had a downturn. And part of the reason I feel worse is because it's directly, you know, it's not impacting my, you know, my investments and my clients' investments, but it's just affecting how we're operating and how we're feeling and how it's a health issue and how we're all scared and we're worried about our health and our future. But I pretty much can say with some certainty that a year from now or 2 years from now, we'll look back at this time and say, wow, that was just, you know, the most ridiculous, crazy thing that's ever happened in our lifetimes. But things will move forward, and they'll move forward in a positive way with all the ingenuity that our population has, with all the productivity that we can get, all the exciting things that are happening in technology. And there are winners and there are losers in this current environment. If you look at Zoom, what we're on right now, I think they had 10 million, you know, maybe 10 million users in December. And now they're up, you know, in the hundreds of millions of users, 30 times, you know, revenue generation in a short period of time. So there's all sorts of situations out there. But for me personally, you know, it does feel a little bit different. And I feel that we're in for some really uncertain economic times, and the numbers are going to be way worse. Now, having said all that, I'm very fortunate to have in our organization 3 portfolio managers that have the highest possible training in managing people's monies. We also have a financial planning arm of our firm, and those are the things that I think that are really important is setting up a proper financial plan and guidance to begin with, so that you can run through these major corrections and downturns and still feel comfortable that, you know, you have to adjust your plan, but at least you had a plan to start with. But in any event, I'm very fortunate that I have 3 outstanding portfolio managers, and John McKinney's with us today, and I'm going to let John talk about really the technical side of things and what his view is. So over to you, John.
Okay, thanks, Gary. My focus will be on investments, but maybe before I do, I just want to say thank you to those people that are really doing the heavy lifting in this, which doctors, nurses, technicians, cleaners, the whole thing. They're the ones really doing the hard work through this whole period. We're in an unusual time. Certainly in my lifetime, it's unusual. You think back 4 months ago, none of us had heard of novel coronavirus. And now it seems like it's all we talk about, certainly in my world. From an investment perspective, we see kind of three issues here. First of all, the virus. How do we get rid of it? Vaccine, treatment, herd immunity. So first of all, the virus. Secondly, the economy. How long will the economy be down for? And it certainly is down now. And when will it recover? And then number three is the market. And that's kind of our focus, but it really derives itself from the first two, the virus and the economy. I'll start with a couple comments on the virus, and I think everyone probably knows all this stuff. We now have, I think, about 3.8 million people that are confirmed with it and growing daily. Actual cases, I'm sure, are much higher. As you know, I've got a couple of friends that believe they had it, and they're not part of those stats, and I'm sure that goes on throughout the world. And we have no widely accepted treatment or vaccine. There's a lot of rumors and discussion and so on, but as far as I understand today, there's no treatment or vaccine that's effective. Bill Gates and Dr. Tony Fauci, who's the director of the National Institute of Allergy and Infectious Diseases and is part of Trump's coronavirus response team, the two of them, Bill Gates and he, think that we're 18 months. So from today, 18 months to getting a vaccine, which is really thought of as how we're going to solve this problem. Vaccine solves the problem. So 18 months, we're hoping for a shorter time, but that's kind of where we're at. Bill Gates wrote a great article on his blog on April 30th. I highly recommend it, kind of discussing the whole process of how we make vaccines these days and so on. Having said that, on the positive, there's certainly signs that the growth of the virus is flattening. Certainly in Europe, we see that, and to some degree in North America, in British Columbia, definitely. New York has closed the temporary hospital they set up in Central Park. Germany is opening schools. Italy is now permitting construction. Spain is allowing some small business to open. So we're starting to see a move towards some normalization, although we are concerned about what that will lead to in terms of additional deaths and our additional cases and deaths, I guess. China, where it all began, has really kind of stopped the virus in its tracks. They're around 80-something cases, if you trust their numbers, which we don't necessarily always do. But they really are kind of moving their economy back to normal, although they are a big export-driven economy, so normal won't be the normal they're looking for. Jay Powell, the head of the Federal Reserve Bank, has said that this virus will define the timeline. So we're really number one is the virus. Number two is the economy. So the economy is being put on hold. We're in a recession. We have had 1 month of minus 4.8 growth first quarter, and that was after a good start. The second quarter, which ends in June, will be negative. We obviously don't have those numbers yet, but it will be negative unless something crazy happens. 2 negative quarters is a recession. So we think we're in a recession right now. Consumer spending dropped 7.5% in March, and it'll be worse in April when the numbers are released, and it'll certainly be worse in May. Consumer spending represents 70% of the U.S. economy, so it's kind of been the key of the world economic growth. Jobless claims in the U.S. Have hit 30 million. Last week hit 30 million, a massive number. The weekly update in jobless claims is getting less than it was before, but it's still adding to the total. We're at about 16.4% unemployment. The unemployment rate in the US is projected to be 16.4 next month. And it may still be getting worse. There is a lot of economists that believe that we may hit depression level like unemployment. The highest rate of unemployment during the Depression in the 30s was 24.9%. So we're moving in that direction, which is pretty scary. PMI, or Purchasing Manager Indexes, which is a big driver of economic growth, have hit lows in Europe, 31% in Europe and 27% in China. Anything below 50 is a contraction. The US was 49% in March, and April down to 41%, so trending in the wrong direction. So that's a problem. And on top of all this, we have the issue of trade, which was the topic, say, going back to January, December. Trade between China and the US, which was under pressure. There was an initial deal done between China and the US, but we're now seeing that the US administration is to some degree blaming China for the outbreak of maybe unfairly, for the outbreak of coronavirus. So we're not optimistic that US-China trade is going to move into a better territory, certainly in the short term, as we anticipate the US election in the fall. And the Democrats, Joe Biden is also playing the negative card on China as well. In Canada, I'm jumping around here a little bit, but in Canada, one of the big issues is the price of oil. On March the 9th, Russia decided not to support Saudi Arabia in reduction of their oil output. The issue there is they were constricting their supply, and yet the shale producers in the US kept increasing their supply. US had become the biggest producer on the planet, and Russia wasn't happy with that, so they decided to take off their hold, and Saudi Arabia did the same thing. It caused the price of oil to actually drop into negative territory, which it had never done before. It's regained its price in the last couple of weeks. It's up to about 23. It's down today, but up to about $23. So things have improved a little bit there, but that is certainly a big issue for Canada. Oil, Canada has always been kind of considered a bit of a petro country, and oil has continued to be a big part of our economy, much less today than it was, but still a big part of our economy. On the plus side too, TransCanada, or TC Energy, is now going ahead with the TransCanada pipeline and the Keystone pipeline, as well as the TransCanada pipeline. So some movement there. So those are positive things. So again, the issue is, when do we get back to normal in the economy? And again, this is really an issue about the vaccine, how we get a vaccine to treat this. The other kind of issue to focus on in the economy is the US administration, and all administrations around the world are doing pump priming. Fiscal stimulus is over $2 trillion in the US. If you throw in now, what is equivalent to quantitative easing or bond buying, the US fiscal stimulus is now around $6 trillion. So a massive US government intervention in the markets to prop up the government. And other countries are doing that, including Canada. So that's a positive for the economy. But economy in not great shape now, and we've got a ways to go, I think, on that. Moving to the market, the 2020 bear market, so in this case, a drop of 30%, took 22 days. That was the fastest bear market in the history of markets. But if we look at some historical context, over the last 50 years, we saw Black Monday. Garry referred to that, 1987, when the markets crashed over 20% in a single day. We had the tech bubble in 2000, which saw the NASDAQ drop 66%. We had the great financial crisis of 2008, 2009, where we had about a 60% pullback in markets. And in all cases, so the kind of the last big three, the markets recovered and then gained some. So we've been through bear markets before. This certainly won't be our last, but we're in the thick of it now. To put this in perspective, I want to read a quote. So on October 16th, 2008, right in the heart of the Great Recession, and 1 month after Lehman Brothers was filed for bankruptcy, Warren Buffett wrote a piece in the New York Times entitled "Buy America, Buy American I Am." So at the time, the markets were in a tailspin and the economy was faltering when Warren Buffett wrote, I'll read this, "A simple rule dictates my buying. Be fearful when others are greedy, and be greedy when others are fearful." Buffett's most quoted quote. And most certainly, fear is now widespread, gripping even seasoned investors. To be sure, Investors are right to be wary of highly leveraged entities or businesses in weak competitive positions. But fear regarding long-term prosperity of the nation's many sound companies makes no sense. These businesses will indeed suffer earnings hiccups, as we expect now, as they always have, but most major companies will be setting new profit records 5, 10, and 20 years from now. Let me be clear on one point. I can't predict the short-term movements of the stock market. I haven't the faintest idea of where stocks will be higher or lower a month or a year from now. What is likely, however, is that the market will move higher, perhaps substantially so, and well before either sentiment or the economy turns up. So if you wait for robins, spring will be over. End of his quote. So Buffett's message was in the fall of 2008. It was early. The market dropped significantly after he wrote that piece, bottoming on March 9th, 2009. But the message was right. It paid to be invested. One of the key drivers of the market, we talked about the Fed, one of the key drivers of market appetite or risk is driven by the Federal Reserve Bank. The Federal Reserve Bank is showing that it's basically prepared to keep adding liquidity to the market, to the economy and to the markets going forward. And they've reduced the federal funds rate to 0 right now. So federal bank is pushing this market forward, pushing the economy forward. And there's an old expression which says, don't fight the Fed. This point was bang on in April of 2020. This past last month, which was the best month for equity since 1987, and the S&P 500 was up 12.7% in April of 2020. So that was the Fed kind of getting the market's attention. Here's one more thought, kind of on the positive. Sort of on the positive. The Spanish flu lasted from January 1918 to December 1920. Cities around the world were on lockdown. A quarter of the world's population, or about 500 million people at the time, were infected. And the death toll is estimated to be between 50 and 100 million people. The Dow Jones Index in 1918 was up 10.5%. The following year was up 30.5%. And from 1921, it rose 500% in the decade that followed. And at that time, the US Federal Reserve didn't cut rates, it actually moved rates up, and there was no fiscal stimulus. So we do need to kind of look through these. That puts it in kind of historical perspective. That is the one kind of historic example that may be somewhat analogous to what we're going through here. It was a horrible event, as we're going through now, but in terms of investing, it was the start of some positive markets. Morgan Stanley predicted that there'd be significant US GDP growth in the second quarter, the quarter we're in right now, of minus 30%, and that certainly looks like the case. They made this a few weeks ago. But with significant upgrowth in the second quarter, they probably have revamped that and moving back to at least the fourth quarter, but significant growth of kind of equivalence in the following quarters. And JP Morgan recently said this: risky markets should remain volatile as long as the infection rate creates uncertainty about the depth of the duration of the COVID recession. But enough has changed fundamentally and technically to justify adding risk systematically. Most risk markets have probably made their lows for the recession, except perhaps oil and some emerging market currencies. So this was written around the time the market bottomed in mid-March. It bottomed March 23rd. This was written just after that. We have had a significant recovery from that, so they would revise that wording, but they were certainly kind of getting at that markets had kind of reevaluated their levels. So how do we approach this as investors? We can't tell you what the market will be tomorrow or next year or next quarter. Market timing is really impossible, as Warren Buffett said in that quote I read. What we can tell you is they think there will be a bottom, and we think holding investments in companies that can weather, key point, companies that can weather this storm will be profitable long term. We think it is time to have some assets invested, and in the coming months to consider deploying excess cash when we do see that the market may be bottoming, and that's a difficult call to make, but we do think that will happen. Insider buying of S&P 500 stocks in March hit its highest level since 2008. So there's a positive. And just in terms of how we approach, I'll just kind of wind up by saying this. So as investors, we take a long-term view. We have reasonable diversification across different strategies and holdings. We pick good managers who oversee and rebalance portfolios. We invest with conviction. We don't just buy the index. We invest in small and mid-sized companies. They often fly under the radar, but again, balance sheets are important. We have a value style, which means we invest like a business owner. We don't just trade. And we consider investments like real estate, long short funds, and true hedge funds. These are often neglected by retail investors, and we keep our fixed income conservative. We don't reach too high for yield. We think, on balance, taking this approach in the long term provides the best returns for investors. That's my kind of comments, Rabbi, on what we see today. Some good, some bad. I'll kind of hand it back
Thank
to
you,
you
John.
for questions.
Thank you, John. Thanks. Before I get to my questions, I want to remind everybody who's watching, if you're watching us via Zoom, you can use the Q&A button down at the bottom to put your questions in there, and others can have the opportunity to read those questions and to vote them up if there's specific things that seem to be trending. I do have a couple of questions I wanted to start with. First, I just want to thank you for that really broad and important overview. I come at this obviously as a rabbi, but our tradition, has long seen the connection between the spiritual and the physical. I mean, there is a passage in Talmud, im ein kemach ein Torah, im ein Torah ein kemach. If there's no sustenance, there can be no spirituality, no Torah, and if there's no Torah, there can't be any sustenance. And so these things do go hand in hand. We do know that what sits in our bank account affects what sits in our heart or our mind and our soul, and vice versa. And while money can't buy you lots of things, that sense of relative security and being able to plan for your and your children's future is an important part of our emotional and spiritual health. So this isn't just about bucks and cash on hand. Mm-hmm. So to your point, and I know you said you can't predict what the market's going to do tomorrow or next week or next month. But what is your outlook? So now I'm going to ask you to do what you said you couldn't do.
Yeah, sure. Yeah.
What's your short-term and medium-term outlook for the markets?
Well, the market, if we take the Dow as kind of a guide of what the market's done, the market was just under 30,000 in February when it peaked, and it rolled all the way back to about 18,900. From that point, we've had a recovery. So we're down today, and we were down a little yesterday, but we were up over 24,000 now. So we've had a pretty significant recovery in the markets. And Garry and I have chatted about this. We certainly are concerned, as are a number of people in our industry, that we haven't, that from this level, we may see a retraction again. And the issue is we're going to continue to see bad numbers coming out of the economy. And we could see this market pulling back from here, from these levels, because the market is fairly high. We think that things are moving in the right direction in the economy, but we do think there will be kind of recurrence of infections in different parts of the US, for example. The virus is really taking off, unfortunately, in countries like India and Africa and so on. So there's kind of the whole emerging market issue with this thing. But again, to our kind of an earlier point, kind of to Buffett's point, if we wait till things are good, the market will have built in what the expected kind of present value of future dividends from investing in public companies will be. So the value will be there already. But from here, short term, I'm expecting a bit of a pullback. So we're kind of sitting, in some of our accounts with a little bit of cash, but I think there's going to be opportunities, if we see that pullback, those will be great opportunities for reinvestment. So higher, longer term, perhaps a pullback coming in the short term.
Garry, anything you want to add to that? You're muted. Do I have to unmute you? There you go. Sorry. Go ahead, Garry.
Yeah, John and I have talked a lot about this. Again, it's hard to be a market timer in terms of when you should take advantage of these kinds of opportunities. I think the news that's going to come out in terms of the economy is going to be something that's going to be fairly shocking for the general public. And I think, that'll have some impact. And I think also people's habits, consumer spending is going to be way worse, even post pandemic than it is right now. I think we're all sort of looking at what we're spending money on, how we're spending it, doing things differently, spending a lot of time at home. And so I think a lot of that will probably carry over post pandemic. So, that's definitely going to have impact on the economy. And so I'm in the camp that says that, we're not going straight up from here. There's going to be some fairly volatile times over the next period of time.
Yeah, I look at the ripple effects that this is having on, just things like we were talking earlier about a wedding, and then the caterer, the florist, the hairdresser, the seamstress, whatever it is, all of those people that are impacted by that one event, which is pretty commonplace. They happen every weekend, and there's whole industries that are built around them. And if those aren't happening, all of those industries, I saw a thing on the news the other day about a caterer. When are people going to feel comfortable having an office luncheon again, where they would invite that caterer to come in and to serve, a lunch to employees that may not even be working in the same building anymore? So all of those things, will we return to what was, or is it going to be a new version? And the opportunities that come with all the new businesses and industries that get created out of necessity, and it being the great mother of invention. But I'd like to talk for a second. We're getting one or two questions online, and I'll come to them in just a moment. I'd like to talk a little bit about the stimulus and the debt that, obviously we look at the United States, but we can look closer to home at Canada as well. The debt that we are accruing to prop up the economy, and what the long-term ramifications are going to be for that in terms of taxes and the hit that our children are going to take, from the checks that are being written today. Are you worried about anything there? Do you see opportunities in any of that?
Yeah, the debt is a real concern. I support it. I think it's, and I think most people support it, in the market that in the world that we need to do this to keep the economy going forward. But we are really strapping on a lot of debt. We're individual debt is increasing, not so much in the US, although, because savings rates are actually high in the US. But personal debt, corporate debt, which had been building in the U.S., it could be higher, and then of course government debt is way over the roof. The issue, the first issue with debt, and you can see this kind of a little bit in the gold market, which is firmed up a bit. It hasn't traded super high, but gold's trading around 1,700 now, and it was down around 1,400 not too long ago. It's inflation. So the concern with inflation. But most people right now are saying, look, the biggest concern is deflation. With the slowing economy and asset values dropping, really, we're much more worried about deflation, which is a real negative. It causes people not to move ahead in the economy, than inflation. And so I think we're trying to balance that off. The other issue too, Rabbi, I think, is that debt tends to slow the economy. High government debt tends to slow the economy. So I think that its existence may kind of pull back on, say, U.S. growth in years to come, and that, a lot of people are worried about that aspect of it. So yeah, it's a concern. I think it's the right thing to do. I think it's the right thing to get things going. We have to do it, and I think we have to do it. And but there are concerns around it. Yeah.
Yeah, just to add that I think one of the big impacts that'll take place is obviously increased taxation. It won't happen immediately. Got the economy back on its feet again, but I would expect that some of the movement, certainly in Canada, towards wealth taxes will be implemented a lot sooner than originally thought. I wouldn't be surprised to see an estate tax in Canada, and I wouldn't be surprised to see a marginal rate at the top rate, upwards of 65, 70%. So those are going to be some of the things that, as John said, over time, because of the debt, will slow the economy down, because they're going to have to repay it somehow, either austerity programs, from government, having less staff, having less projects. That in itself is destimulating. So, those are some of the things that that are going to be impacted into the future. You're muted.
You're muted, Rabbi.
Sorry. I want to go to one of these questions that was online. Are you guys able to see the questions also?
No.
I'll read it out loud here.
Okay.
So are there any sectors, industries worth considering for investment at present at the bottom of the market? And if you're comfortable with a longer time horizon for that investment?
Well, yeah, I get that question a lot. It's interesting. I've got being a kind of a market guy in Vancouver, we know a lot of people that are heavily invested in the resource sector, particularly precious metals, which has been getting a lot of attention lately, certainly investor attention in precious metals. The problem is with gold is it produces nothing. It doesn't pay a dividend. It doesn't pay interest. So it's a fully speculative investment. So while some of our portfolios do have some exposure to gold, it's very difficult to move in that direction. And if we do see, mild deflation or something, we could see the price of gold pulling back. I think some people are buying gold really as a kind of an insurance policy. So I have a hard time getting too heavily involved in that in one sector like that. The other sector that there's a lot of chatter about is the oil and gas sector, and it's become kind of a dirty word. A lot of people won't invest in it because of environmental concerns and so on. But it was beat up in the fall of 2019, and it's dropped about 50% from that level in 2020. So it is absolutely rock bottom. So if you're aggressive, you could put a little bit of money into the oil and gas sector, but it's really dependent on the economy returning. And right now we've got all of the reserve capability, all the energy reserves are full now, all the storage capacity is full now. And that was what was driving the price of oil down, that we've really produced more energy than we can utilize. So I think that's a long story. I think maybe in a couple of years we'll see strength in energy, but I don't see, while the economy is slow, while people are not traveling, the CEO of Air Canada was saying there was one day recently where we didn't send any jets to the United States. I mean, that's a big deal for Air Canada. We're not traveling like we used to, and the same is for travel and cars and so on. So those are the two that jump out at us. What we look for in sectors is we look for companies that have good, strong balance sheets. So they'll survive. If this goes on for months, they can survive that period. They're not beholden to their debt holders, to the debt givers. So those kind of companies, and the companies that have the opportunity for growth on a go-forward basis is what we would kind of allocate to, and that's across the map. May not be things like hotels, airlines. Warren Buffett on the weekend announced that he had sold all his positions in airlines, saying that industry now has had a fundamental change, which is quite significant comment coming from kind of the world's most famous investor. But we look for strong balance sheets and companies that will survive and do well on a go-forward basis.
Yeah, I'd like to just add, I think there's some tremendous opportunities in looking at companies and being that debt holder. John mentioned debt holders. I think every asset class pretty much took a hit from the peaks, no matter what it was, other than gold and other than having cash. Credit, where you have investment grade bonds in a solid company, it took a massive hit. And so in terms of when when the recovery comes back, and as long as these bonds don't default, and you get your 100 cents on the dollar maturity, there's some really good opportunities in that space. So it tends to operate like a bond on the down when it goes down, and operates like an equity when things start to recover. So there are some good opportunities there, and we have access to a couple of managers in that arena.
Mm-hmm. Speaking of cents on the dollar, one of the questions that comes in is about the Canadian dollar. People are thinking maybe a 60-cent Canadian dollar to the U.S. What are your thoughts on the Canadian dollar's strength? And I would add to that question that came online, the potential or the opportunities for more regional production, more staying within your borders kinds of development of industry, the diminishing of globalization that may come as a byproduct of this, and maybe the opportunity to see new industries that develop in Canada that we had previously relied on long supply chains for. What are your thoughts on the U.S. Canadian dollar?
Yeah, David Rosenberg came out last week and famously said that he's a bit of a perma bear, but he runs his own economics group, and he was the one that suggested the Canadian dollar could go to 60 cents. Very negative view on the outlook for Canada. One of the managers that we follow, one of the senior guys at Manulife, is suggesting that the dollar is a little low right now, and that it's going to kind of go to the mid 70s. It's about 71 cents today. So there's different views on that. I would kind of tend to go with the latter, stay where it is, or perhaps maybe firm up a little bit. I think, the kind of the rush to U.S. dollars, which we saw as the Canadian dollar came down, it was down about 8%, I think. If you look from, say, December 31st to recently, that's driven by the rush to U.S. dollars, which investors tend to do when they're really concerned about where the world's at. They go to the safety of the US dollar, which drives the US dollar up, and everything is measured in relation to another currency, in this case, the US dollar. So I think that's happened. So I don't follow Rosenberg's advice. I think that the Canadian dollar will stay where it is, if not firm up. And if we did see a resurgence in the oil and gas sector, we're a long way from that, but if we did see that, say, in the next couple of years, that tends to be a positive for the Canadian dollar. We used to be considered a petrocurrency. We're not really now, but we're still somewhat driven by that. So I would say stay the same or strengthen, if anything. But again, currencies are so hard to predict.
Yeah. So another question that has come up is, if I had cash on hand right now that I hadn't donated to the synagogue or to other important organizations, what would be your suggestion for the short term and the medium term to do with that cash?
Yeah, that would kind of get back to our earlier kind of answer about the market. I might put a little bit in the market. We don't know. The market could rise from here. It's still a significant ways off its highs from February, although February's highs, many people were considered slightly overvalued. But you might put a little bit in the market, but I would be fairly cautious right now with investing. You can certainly allocate some to, as Garry mentioned, fixed income can be a very safe place to be. I mean, bonds are promises to pay. So as long as the promiser is able to make that payment, the value will go back to par. And a lot of investment grade bonds are trading below their par values. So if it's a $100 bond, they're trading below 100. So there's an opportunity there, and you're in a much safer part of the capital structure of the firm. The key is that you have to make sure you're with companies that will be there when the bond comes due. So room in bonds, and then we use some alternative strategies that use hedge strategies, long short strategies, and you can certainly allocate to those. One of our hedge strategies is up about 1.5% this year, so it's kind of weathered this horrendous period by being up 1.5%. So there's kind of safety in that strategy. It's market neutral investing, so it's investing that doesn't get tied to the market. So you can maybe make some allocations that way, but in terms of going long equities, the risk capital, I'd be very careful. Maybe part of it, but careful.
Yeah, I'd add to that I'm a strong believer in what the term dollar cost averaging. So if we have $100,000 to invest, we'll put in $10,000 a month over the next 10 months. I think that's a great strategy. And if things really hit a decline, then you have the option to obviously put more money in. I think that's a great way of stepping into this marketplace. I think more importantly is really understanding what your risk tolerance is. I think one of the problems that we've had is since March 2009 all the way through to February 2020, it's been pretty much straight up in the U.S. markets, and people haven't really and real estate. Real estate's been everything's real estate, right? So I think it's really interesting now that we've had this current decline that people have a better understanding of risk, and what you really need to understand is what your risk level is and what your tolerance is for risk, and having a plan developed based on that.
Right. We don't know for sure, but it looks like Canada is going to pull out of this phase of the pandemic sooner than the United States. It looks like we've weathered it a little better for probably a variety of reasons that we didn't need to go into. But if the U.S. stays in a recession longer, how does that impact Canada, and what action should we take in our portfolios?
Yeah, I think let me jump on this one. The difficulty, and my presentation about the economy, I talked a lot about U.S. statistics, and we really need to be focused on what the U.S. market is doing, just because they are so much bigger than us. It's about a 10 times bigger economy than the Canadian economy. So it's very difficult for the Canadian economy to really outstrip the U.S. economy. It has in the past, but it tends to be driven by exports. So a very strong resource sector. When China was building out back in 2011 and so on, the resource sector was strong. That allowed Canada to grow faster than the U.S. But really, the Canadian economy is so tied to the U.S. economy, and I think that we're going to have to kind of pay attention to that. This kind of bringing manufacturing back to North America, Rabbi, which you mentioned, I think we certainly have been seeing a little bit of that. I think virtually all companies are now analyzing where they're getting supply from, the safety of getting supply from countries like China, where there may be issues with importation and duties and so on. So I think there is more of that going on. And I think with the Canada-US trade agreement that was recently done, we can participate in that as well. So I think there are possibilities for continued strength there, but I think we do really we will kind of track what happens to a large extent happens in the US.
Yeah. A couple of questions came in online here. One of them is our outlook about real estate investments and trusts. And then I'll just ask the second question. Maybe they weave together. I don't know. The synagogue has had a great deal of interest and tried to provide leadership on our environment and climate change. And there was a big move before this pandemic to make sure that individual and organizational portfolios were green investing. Now we've seen the planet get a bit of a reprieve, short-lived for sure, but from this pandemic, the skies have never been cleaner, and the streets have never been emptier, that kind of thing. Is there an opportunity for investment in green initiatives, in renewable energies, those kinds of things in the midst of this? So those are two completely different questions, one on real estate and trust, the other on environmental investments.
Well, I think let me just start with the real estate side. We offer several real estate funds, and the real estate investment trusts have obviously been hit particularly hard because, are they going to collect rents? Right now, when you think about it, if you own an apartment building, the government's helping the tenant pay the rent. And there's so much government stimulus to help people pay rents, and there's rent reductions, and there's commercial rent reductions, and all these things. And the issue is going to be going forward, when you think about it, is what's going to happen when that stimulus stops? Are people going to be closing their businesses? Are we seeing permanent damage on the real estate side? So, I think there's definitely some opportunities. I think the ones that, the types of companies that we want to look at are real estate investment trusts that weren't borrowing money to basically pay their distributions to their investors. If there are real estate investment trusts that aren't over levered, I think there's some really good opportunities in that space. But it's really interesting. Real estate really hasn't had a big hit like it's happening right now. We haven't seen that since 2008, and really in 2007 to 2008, it wasn't as bad as it is right now for real estate. But there's certainly opportunities, and I think there's going to be a lot of casualties in the real estate arena.
Mm-hmm.
I would agree with Garry, and then maybe just add that if you're looking at the kind of Canadian real estate, the numbers coming out of Toronto for last month were horrendous in terms of the drop in activity in the Toronto market. And Vancouver is kind of in a similar space, with a lack of supply and demand and transactions being way down. There's a lot of concerns locally with real estate values due to the new rules around divulging ownership of properties and so on. It kind of applies to high-end property more in particular. So there's a lot of ups and downs. But I agree with Garry. I think there's opportunity with well managed real estate in the appropriate markets and with proper diversification and not excessive leverage, because as the economy returns back to normal, we will see that. But I would kind of look at, say, Vancouver real estate. I think there's more factors involved that need to be looked at when you're kind of valuing just the Vancouver real estate, for example. And Rabbi, just to jump to your comment on green technology, a lot has been written about that recently too. And the challenge for that too is two things. One is, basic energy prices have dropped so much that it makes green energy more expensive, and that's going to be a bit of a headwind, I think, for green energy, just on a price comparison basis. So natural gas prices are down, not as much as oil, but then oil is down a lot, and so that driver to move to, say, in cars, to move to electricity is less than it was, say, a year ago. So that's one item. And then number two is a lot of the movement to green technology has been supported by government programs. And the question will be, Garry talked about raising taxes and how do we pay for the deficits and so on. But the question will be, will governments pull back from that support of green technology? And that's to be determined, but I think you need to be cautious that may have an effect on some green technologies.
Thank you, guys. Just before we wrap up, we're just about out of time here, so I want to thank you for answering those. I guess I'd ask one more question, which is, maybe it's been woven throughout all of your answers, but I've always looked for the blessing in the midst of the curse, the silver lining in the storm clouds. From your own experience, and it doesn't have to just be markets; it could be, really in terms of how families or companies are managing their finances as well. What are the blessings in the midst of this pandemic? What are the good things that are coming out of this in terms of resets, in terms of lessons learned, that kind of thing?
Well, from my perspective, I think you have a whole new appreciation of family and family time and being able to spend time with your loved ones, the people you care about. I mean, this is a health crisis. And that's what's causing all this economic stuff is secondary. And this is a health crisis. There's people that unfortunately are passing away. People are scared about their health. I think the other thing is appreciating the fact that you can hug your family, and how right now you're not allowed to hug your friends or other people. I think it's an interesting, the whole thing is that whole socialization is dramatic and could be generational with how our kids are adapting to something that nobody's ever seen before. So I think there's a blessing in there. I think the appreciation of family, I think there's appreciation of things are more important than what we're talking about in terms of money. I think there's a certain level of equalization in this whole process that everybody's in the same boat. Everybody's in the same boat. So I think there's some really positive things there.
Yeah.
I would echo Garry on the personal level. I speak to my parents now virtually, every day. I didn't used to do that as much, and so there's a real positive to that. Not wanting to end on a negative, I am concerned, kind of based on what Garry was saying about what this does for the economy. And certainly could be a reshift. And Rabbi, you kind of mentioned it as well. Will people react more differently on a go forward basis in terms of consumption? And I kind of think, in talking to people, friends or people in the industry and so on, we probably will get back to wanting new cars and travel and the things that I guess people aspired to in the past. But that's a big question. There is kind of the other broader issue, I think, is the challenge that we're seeing around the world caused by the difficulty of the virus, and it's part of it. We see what's happening in Brazil with prisons and what we see what's happening in Iran. Iraq is in trouble because of the price of oil. What will India look like with 1.1 billion people and the virus, very little testing and that kind of, I'm concerned about the broader issues that may come from this. But on the positive for me personally, it hasn't been a bad time. We've spent a lot of time with family. So.
Yeah, I mean, I would echo that. I would say I hear, as you guys do from many folks who say, look, this is, it's terrible what is happening, and it's scary and all of those things. And those that are fortunate to have family close by and to have a home that's secure, even in the midst of that, there's a slowing down that's taken place that I think we all felt we needed but couldn't take until the world forced it upon us. And I think it's also highlighted, the inequalities in our society that I hope will get the attention that they now deserve, in terms of our public health, in terms of Indigenous peoples, in our homeless population, those that are food or home insecure. I think that this is really highlighted, here in Canada and certainly in the United States as well, where I come from, the places that society has really, failed in its social contract. And I hope that, like all these other sort of seismic shifts that have taken place throughout history, be they wars, recessions, depressions, those kinds of things, we don't seem to learn and apply all the lessons that we could have from those, but we have in the past learned some good ones and applied them well, at least for a period of time until we forget them and then we make the same mistakes again. I want to thank you both for your time this afternoon. I want to thank those that joined us online. This has really been a wonderful conversation. And, again, I would say that, it is both Kemach and Torah. It is both, the money in your pocket, the sustenance, and the spirituality. And those two are not disconnected. One allows us to do and express the other. And so I thank you for adding a spiritual level to this also. And helping for some of us, if not, fully removing our anxiety about the economics of the situation in the moment. Knowledge is power, and having some answers to those questions has been so helpful. Thank you both very much for joining us. And to those that are watching online, I'll just quickly share my screen to let you know about the upcoming events that we have in this same series. So we hope that you'll join us on Tuesday, May 12th at 7:30 for Practical Ideas for Effective Parenting During COVID-19 with Dr. Gail Krivel-Zaks, a registered clinical counselor, and Rabbi Carrie Brown. And then on May 20th at 2 o'clock, Essentials for Effective Estate Planning with Michael Scott, a wills and estates lawyer, and also Rabbi Brown. And as I mentioned, we're in conversation with our Member of Parliament in the Vancouver Granville, writing Jody Wilson-Raybould for a virtual town hall, to talk about the government's response as well. Thank you for joining us this afternoon. Temple is still doing what Temple does, so if you need anything, please call the synagogue office or find us online at templesholom.ca. Services Friday night at 8:15 online at Facebook, YouTube, and our website, and on TELUS channel 8915, and Saturday morning at 10 a.m. And then we have a wonderful bat mitzvah for Mia Colette that'll take place online as well. Have a wonderful afternoon. Gary, John, thank you very, very much.
Thank you, Rabbi. Thank you very much.
See you soon. Stay safe. Thank you, guys.
Thank you.
Thank you.